Hello, friends. If you receive the state pension, or you're getting close to it, what I'm about to share with you could genuinely change how you plan the next few years. New tax projections published this month are pointing to something most British pensioners have never faced before. Financial analysts are calling it a fundamental shift in how the state pension interacts with the UK tax system. Stick with me, because by the end of this video, you'll know exactly what's coming and what you can still do about it. Welcome back to Pension and Benefits Guide. If you're new here, this is the place where we break down pensions, benefits, and everything the DWP doesn't explain clearly enough, in plain, simple English. If that sounds useful to you, stick around. Today, we're covering four developments that are all converging in 2027. Some of this is already confirmed. Some of it is based on very recent data. But all of it affects you directly if you're on the state pension, or if you have private pension savings of your own. Let's start with the big one, the change being described as the most significant shift in the history of the state pension. For the first time, the numbers may no longer work the way pensioners have always assumed. August wage growth data came in at 4.1% for the May to July period. Under the triple lock, the state pension rises every April by whichever is highest out of three things: September's CPI inflation, wage growth for May to July, or 2.5%. With wage growth at 4.1% and CPI expected to land somewhere around 3.4 to 4% in September, the triple lock looks on course to deliver an increase of roughly 4.1% from April 2027. On the current full new state pension of £241.30 a week, that works out to about £9.89 more per week, bringing the total to approximately £251.19 a week, or around £13,062 a year. Here's the part that changes everything. The personal allowance, the amount you can earn before paying any income tax at all, is frozen at £12,570 until at least 2028. With the state pension projected to reach £13,062 a year, it would sit around £492 above that frozen threshold. That means, for the first time in the history of the British state pension, someone receiving only the full new state pension, no private pension, no savings interest, nothing else, could owe income tax simply for receiving their pension. At the basic rate of 20%, the tax on that £492 works out to roughly £98 a year. Not a huge sum on its own, but historically, it's a big moment. Here's how it would actually be collected. HMRC would send out a simple assessment letter based on data from the DWP. But if you also receive a workplace pension, HMRC would instead adjust the tax code on that pension, and your provider would simply deduct the extra tax automatically, no letter, no warning. Some pensioners are reportedly already noticing smaller than expected workplace pension payments, as codes are adjusted in advance of this change. But the most important part is what comes next, because this second development affects something many families have relied on for decades: passing on pension savings without inheritance tax. From the 6th of April, 2027, most unused defined contribution pensions, personal pensions, workplace pensions, SIPs, will be included in the inheritance tax estate for the first time. This was confirmed in the Finance Act 2026. Right now, pension savings pass to beneficiaries completely outside the estate, free of inheritance tax. That protection ends in just a few months. Here's the detail that financial planners are most concerned about, and it's the part that gets the least attention. Under the new rules, it's the pension scheme administrator who has to pay the inheritance tax on the pension pot before releasing anything to the family. So the money is reduced before it even arrives. For a family who was planning to use part of a pension payout to help cover inheritance tax on the rest of the estate, say, on a family home, that plan simply doesn't work anymore. The pension itself gets taxed first. The family has to find the money to cover the inheritance tax from other sources, potentially creating a genuine cash flow problem while waiting on probate. The window to prepare for this is just a few months. Some options being discussed include adjusting pension drawdown now, considering gifts from pension proceeds, and reviewing how assets are structured, but any of these decisions would need to happen before the 6th of April, 2027 to matter under the current rules. Now, before we go further, if you're finding this useful, this is a good moment to hit like, subscribe if you haven't already, and drop a comment letting me know which of these changes concerns you the most. It genuinely helps this channel reach more pensioners who need this information. Let's move to the third development. This one's about ISAs, and it's a little different, because it's not confirmed policy yet. Just a direction worth watching. The annual ISA allowance has been frozen at £20,000 per person since 2017. Adjusted for inflation over that time, the real value of that allowance has shrunk considerably, even as savings balances and interest rates have gone up. Some analysts believe there may be regulatory pressure to shift savings toward productive UK investment, which could mean less favourable treatment for cash-based ISA holdings down the line. Again, nothing here is confirmed. But the direction of the Pensions Act 2026 suggests it's a trend worth watching. The practical takeaway is simple: if you haven't used this year's £20,000 ISA allowance, you have until the 5th of April, 2027 to do it, before any potential changes are announced. Here's where the real impact becomes clear, because all of this only matters if you actually do something with it. So let's talk about 3 things you can still act on right now. First, the 25% tax-free lump sum. If you have undrawn defined contribution pension savings and haven't yet taken your tax-free cash, you're currently entitled to take up to 25% of your pot completely free of income tax, up to the current lump sum allowance of £268,275. There have been persistent rumours that this allowance could be reduced in a future budget. Nothing is confirmed. But if you've been considering taking that tax-free cash, doing it before the autumn statement on the 28th of October, 2026 is worth thinking about. Second, gifting from surplus income. HMRC allows you to make regular gifts from income you don't need for everyday living, and those gifts fall completely outside your estate for inheritance tax purposes immediately, not after the usual 7 years. If you're someone whose income is building up in a savings account each month rather than being spent, this is a legal, well-established strategy that very few people are told about. And third, update your expression of wish form with every single pension provider you hold a policy with. Under the new rules, whether your pension goes to a spouse, who remains exempt from inheritance tax, or to children, who are now potentially in scope, makes a real difference. Make sure your paperwork actually reflects your current wishes. So let's bring it all together. Wage growth of 4.1% has the triple lock-on course to push the state pension to around £251.19 a week from April 2027, which would, for the first time, exceed the frozen personal allowance of £12,570. That means pensioners relying solely on the state pension could owe income tax for the very first time. From the 6th of April, 2027, pension pots will also enter the inheritance tax estate, creating potential cash flow challenges for families during probate. ISA rules may face pressure going forward, so using this year's £20,000 allowance before April 5th is worth considering. And there are 3 things still within your control: the 25% tax-free lump sum, gifting from surplus income, and updating your expression of wish forms. Now I want to hear from you. Out of everything we covered today, which change worries you the most, the income tax threshold, or the inheritance tax rules on pensions? Let me know in the comments below. If this video helped clear things up, share it with another pensioner who needs to see it. It really does make a difference. And if you want to go deeper into how the state pension actually works, check out the next video, where we break it down step by step. Thanks for watching, and I'll see you in the next one.